share my screen. First of all, welcome everyone to this update webinar. And let's start first with the trading. So this is the 1 week view. So we see like the week is a bit up and down, a bit volatile. So it seems like that the Iran war could start again, but overall we have a solid profit. And most important is how much do we do in last month. So it's also looking very solid at the moment. It's going a bit up and down. So, but in general, we're doing well. Somehow on the trading side, we're doing also well. It's somehow not loading the trades here, but you can see position history. We're like, we go to this one. So you see we're doing a lot of trades, some negative today, but here come positives again, and you see many trades. So, and yeah, let me switch to my presentation. So this is not just the start of the presentation, but this is what actually our machines see every day, every second of every day, and basically what tools they use to monitor the market and to make trading decisions with our algorithm. And I already introduced myself, and this is only an update webinar, so I will not introduce myself again, but we will have, as Sergey mentioned, we will have like a new beginner webinar where we'll have like the full content. All right, so of course we bet a lot on the hyper-liquid ecosystem, and we think it's a very good ecosystem to be in. We think that the token is a very good ecosystem, a very good investment. And of course, we can say a lot. So also we can check what others saying. And there's the very famous and followed multi-coin capital, which made a hyper-liquid, hype asset prediction. And now the price is a bit lower, but last week was $71. So today the prediction looks even better. And they say that the base target for them is for 2028, $319. So on today's price, this is like a 5x, right? And the bull case, so if we really have like a very good development of the asset, if we have a bull market, could be around $689, so almost $700, and it's a 10x from today's price. And most importantly, why is this case so strong that even the huge funds jumping now in and promoting that and also making their analysis public? One reason is this down here. So 99% of the revenue, what is generated on Hyperliquid, is used to buy back and burn the token. And like here you see there's a little furnace which is burning tokens. And this is what actually happen on Hyperliquid every second, every hour. There's a constant inflow from the revenue, from the trading fees into the burn mechanism. And this means that as more revenue Hyperliquid makes, as more tokens are burned, and as long as it's running, as more tokens are burned. And this is reducing the supply. And already around 4.6, so almost 5% of the supply got burned. And if you calculate this up to 2027, 2028, this will be much more. And still, we expecting the exchange further to grow, right? So like we are completely in line for $2 billion revenue for 2026. And it's just very conservative that the exchange is doubling every year. But all overall, it's a really good ecosystem to be in. The hype is a very good asset, and not only we predicting like a 5 to 10x in the future, but also very famous and big funds which also invested themselves hundreds of millions of dollars into the asset. And yeah, so we have a really good asset to be in. And this is also good for us in trading, which you can see on this graph, right? So if we compare the hype with the Bitcoin, then you see that hype had the last year and a bit more really strong growth. has a constant updates in order to increase the revenue. For example, they started also to add like USDC, and every USDC which is deployed on the hyperliquid exchange is backed by a bond, and this bond is creating interest rate, and this interest rate is used to buy back the token. And for us as trader and algo trader, such an asset, which is growing and moving a lot, is of course much better than an asset which is not moving at all. So Bitcoin was basically flat. We had we lost like 20% over the last year or so. But basically, we having an asset here which has a strong trends, and we're doing trend following as one of the main strategies. And of course, if you have an asset with strong trends, trend following is really the right thing to be in. So, and here you can see, I showed you in the exchange like some of our returns. So you saw we're making 10-20% every month, and this is because we're using different algos. And you see here, this is actually actual data of also from our algos. So you see here like the entry point and the exit point, and we displaying here three algos. So you see like this algo made just like two returns. So like the risk you invest is two returns. So if you invest one risk in this algo, we're getting 2% back, right? And the other algos performed also very well. And you see also what you can see here. That's why I displayed it into this graph. You can see very well that our algos catching the right moment, selling at the right moment, and basically making a constant uptick on our portfolio. All right. And you may be asking, how do we achieve that? And what is our edge compared to all the others? As in today's market, almost everyone with a cloud subscription or ChatGPT subscription can build his own algo. And this is what you can see here. This is basically our digital brain. So we're using an application um, to document our digital brain and also make connections so that it's working like real synapses. And up to date, in the last 6 months, we made more than 1,000 experiments, and we document all these experiments in our digital brain. Of course, they have like a main topics. And then in the next step, we're using AI to also connect the experiments with each other. So if we, for example, testing a certain trend algo, we can connect it also with a certain hedging strategy, with certain signals, or with certain trading strategies, or also combine it with options and so on, and getting the perfect result. And basically, as more we work, as more our digital brain will grow, and the more connections we have. You can see here we have like thousands and thousands of connections, and these connections help us to be on the edge of the market. Another way to see that, to see the development of strategies, is to compare it with DNA. So basically, a strategy, or like a algo strategy, an algorithm, is similar to a DNA string, and it has several genes, right? So, for example, like the entry signal could be one gene, or the risk management could be one gene. And similar, like in the evolution theory, we're doing like many iterations, and through this, some genes evolve and change and improve over time, right? So you can see here like the blue one, right, which go from experiment to iteration till it's getting settled in a final out. But also others just die, right? So the strong ones survive, the ones who can evolve, and the weak ones getting eliminated. And just like the evolution theory, we also have basically a lot of strategies which compete with each other, which have different genomes, which exchange genomes, which evolve and so on. And basically they result then in a final evolution of a strategy. And this is basically also the process what we're doing in our trading lab. So if we have an idea, we compose it into different genomes, and then we let it run through many iterations. We're trying to evolve it, and at the end, when we have a really good result, we're moving forward with it. And the result is what we see here, right? So in the last 12 months, we generated 16,000 working algorithms. So all these algorithms looking good on paper and looking profitable, but then we're running them through a filter process or testing process. So because most of the time when an algo on the paper looks really good, it will not perform that good on the market itself. So that's why we're sending all these thousands and thousands of algos through this testing process. And the first is the Monte Carlo storm. So we are placing these algos on different market situations. They vary, they have a coincidence, and only if they can survive this Monte Carlo storm, they're coming to the next step, which is basically walk-forward testing. I will go a bit more in detail into walk-forward testing into the next slide. And at the end, we're also checking like the sensitivity of the parameters, right? Because algorithm is always a formula, and the formula consists of different parameters. So if you have like x plus 2, x is a parameter, right? And we want to check how x will hold when we change it, right? And the result is that we only have a few strategies which surviving and which we then take live and use on the actual accounts to trade. So the biggest challenge for us on the development of the trading is basically we developing algorithms on the past data. So we're trying to find statistics. And based on these statistics, we're trying to predict the future, right? And this doesn't work always, right? So for example, here we have like a set of different traders or different strategies. So I can recreate it one more time. I have 200 asset managers, right? And for example, I say, okay, I choose this strategy to trade with because it has the best performance, right? So what happens if I choose it? Well, it stopped performing good. And in order to avoid this, we do a very special way of testing our strategies. So you probably heard about backtesting, and backtesting we also doing, but this not helps you good enough in order to develop a robust strategy. So what we're doing is so-called forward testing. So basically, we have like a periods on which we train the algorithm. So we're using the data of this period in order to find statistics, like here in this blue box, right? And then we let run this algo on data which it doesn't know. So it was not trained on this. If you make a backtest, usually you use all the data. You make a backtest of 3 years, and basically you're optimizing on these 3 years. But we create this algo, for example, on 1 year and then let it run 3 months. And like this, we're doing several steps in order to get a really robust algo, right? So we train it, then we run it without training data. Then we train it again, then we let it run again and without data which the algo knows. And the result is the so-called forward test and helps us to make a much more robust framework and avoid the situation like in the slide before that we choose an algo which looks good in the past but doesn't perform well in the future. And I also talked in previously about parameter sensitivity. As mentioned, an algorithm consists of a mathematical formula. So it has like several parameters. So let's say if you make an algo based on RSI, you could say if the RSI is higher than this value or lower than this value, or if RSI is exactly this value, then I go long or short. But also as an algorithmic researcher, we need to check these parameters in detail. And here on this graphic, you can see the way we actually want to trade. So we want to find parameters which look like the green mountain, the mountain with the green flag, and we don't want to find parameters with the red flag. And what does this mountain mean? So the red flag is one parameter somewhere in your data. Let's say your RSI is 16.3. And if you make a trade when parameter is 16.3, in the historic data, you won. But if you change this parameter a little bit from 16.3 to 16.4 or 16.2, you don't make a profit. And this looks like then like a spike in this kind of visualization. So what we actually want to trade is something like a plateau, not a peak. So if we change the parameter, we will be still profitable. So, and if you research each parameter in your algorithm like that, you have the advantage that you're not going blind into the data and trying to find the optimal value. No, you're trying to find the real edge in the data. All right. And the next important thing what we're doing on the trading side, and I mention it often, is we don't only trade one algorithm, we trade a combination of several strategies, right? So, and if I turn off these strategies in this chart, you can see that, let's say so if I have no strategy, I have like zero drawdown and zero return. Let's say I start with this strategy above here, and this strategy above here has a return of 6.7 in average, and return drawdown in 6.7%. So this means the max loss of the strategy was 6.7%, and the total return was 18%. So in general, looks good, but you see it has like a lot of up and down. And now we could only trade this strategy, but then we need to live with this data. So if we want to combine this strategy with another strategy, like this one, right? You can see we in general increase the return, but we also decrease the drawdown. So we're making the equity curve, what you also can see here, I can deactivate it again. We're making it more flat, right? And this is what we actually want to achieve as a trader. So we're trying to find strategies which are not having the same equity curve in order to make this curve more flat, to make the average drawdown more low and the return more high, right? So if I add now some more other algos, you see it's going lower and the return going higher and higher, right? And if I activate all strategies, we come into a result with a very low drawdown and a very smooth equity course. And this we achieve through diversification, right? So we not put all eggs in one basket, right? We're trying to split our eggs into several baskets so that we not rely on only one strategy, that we're not losing money when this strategy performing not good. We're trying to have many strategies and a flat equity curve with a low losses and a good average return. And the next topic where we look a lot is also the so-called regime. So the regime in trading you can kind of understand as weather, right? So if you have a good regime, like let's say if you have good weather, you have a good regime, that could be, for example, trend, right? So this fits very well to trend algos. But there could be also like a crash in the market. So this is a different weather, right? So like weather's hot and rainy, right? Or there could be a choppy market. Choppy market means there's a lot of up and down, but the price doesn't go into direction, which we have, by the way, most of this year in crypto. And there can be also like a recovery market. So after like a strong crash or like the price usually bounces back a bit. And for us, it's also important to understand which regime do we have. So in which phase is the market? So basically, also when you are a farmer, you want to predict the weather, right? When do you put your plants out? When do you take your plants inside? When you take when you do which action. When you put water, right? When it will rain today, you don't need to put water. And same we're doing in trading. We want to understand the weather. We want to predict the weather. Of course, we never know 100%, but there are like certain ways to do that. And of course, we want to then trade the algorithm which fits for this weather the best in order to be the most efficient. And this is called the regime awareness. And one way to do that is so-called the hidden Markov model. The hidden Markov model is very famous in trading, and it's also highly used in crypto. It's not the only model we use, but we can use this as an example in order to understand which market it is. And how it looks basically is like here in my animation. So it's trying to understand if the market is in calm, is it calm or is it in stress? Stress means it have like a short explosive moves, right? So if you have short explosive moves, usually they can also resume fast. So you need to trade differently in a stressed market than in a calm market, right? So for example, in a calm market, you maybe also need to trade a bigger position size, but also need to close that position size more early, right? Because if it switched the market, you need to adjust. And one mathematical model to do that is the hidden Markov model, which we're also using. And if you visualize that, it's exactly look like here. So you can also try that if you're interested in trading and using some paper, building the hidden Markov model, and also depend your trading models based on this model. And at the end, what it does, it's only predict us the weather. And you see also it has a percentage because we never know 100% what the market is. So we only know to a certain extent and can predict to a certain extent. So we're always working with probabilities. All right. And this, what I just told you till now, is what we're doing up to today. We're doing futures trading. And with future trading, we're making already very good results. But also, we are experts in so-called option trading. So options is a different derivative. And basically, they're working like an insurance on the price. So if you buy a call option for hype, let's say hype $80 till end of the year, this means with this call option, you can buy one hype for $80 no matter where the price will be during the whole year. So if the price goes to $100, you can still buy it for $80. And the put option is the same, just opposite. So if you have a put option hype $60 till end of the year, this means you can sell your hype for $60 no matter what the price will be. And options have always like different prices. And basically, what determines the price the most is the so-called volatility, right? And as higher the volatility is, as higher are option prices. So if you look into the S&P, they in average have a volatility of 18%. In Bitcoin, you have a volatility in average of 50%. But in hype, we have a volatility of 100%. But we don't want to use options here to buy them for the long trades. We want to actually sell volatility because the long trades we catch quite well with our algorithms already. But if we combine that with option trading, which we plan in the future, which we're working on, we can farm so-called volatility. This means if we sell an option and this option expires worthless in case of hype $60 put option, we getting the money for selling the option. And if the price not goes below $60, all the money is ours selling this option. And we can basically, after we analyzing the high price, we can basically predict volatility. And we can also estimate if the volatility is now good for selling option or buying option. And how we do that? So basically, we're building like a volatility surface, like what you can see here. And you can see here the volatility surface of the last 12 months. When it's red, this means option prices are very high and basically good to sell. If it's blue, it means option prices are pretty low and it's maybe not necessarily worth it to sell options, right? And you can see it's also options is not like a chart, it's not like up and down, it's a three-dimensional space, because you can buy options and sell options for every moment, for every price, the whole year. And therefore, we need to calculate first the volatility landscape in order to option trades. But then we can do certain ways of harvest the volatility of options. One way is here, one strategy, what we're working is basically we buy a call option which runs for 4 weeks, and we sell a call option which is running only for 2 weeks, and we do it for the same price. So basically, we have like one short option and one long option, and we are so-called delta neutral. But what happens here is basically that the 2 week option declined in price much more fast than the 4 week option. So the volatility harvest can be done through such a construct. And this kind of construct just has a very little risk, right? Because if the price goes up, we still covered by the other option, and still this option lose its premium over time. And this is like one way we can do option harvesting. Basically, we're trying to find on the right with the right signal, the right wave, the right moment when we sell options, and basically getting additional percentage, additional returns on our trading. And the other strategy, what we working on, is so-called covered calls. And covered calls is for us very interesting because we also holding a lot of spot hype token, because we believe in the long-term development of the ecosystem. And as I explained earlier, we believe that the price go to $300 to $600 in the next 1 to 2 years. And of course, if we're holding these options, they just sitting in our, if you're buying hype, they just sitting in our vault, and we just waiting for the price grow. But actually, we can use them for trading. So basically, how we can use them for trading, if we having a 1 or 10,000 hype, we can also sell 10,000 call options. And these 10,000 call options bring us a premium if they expire worthless. So let's say we're selling a call option with the strike price 74.25, and the price for 1 week. And if the price stays below this border, this option expires worthless and brings us on 10,000 hype option another $14,200 a week, right? So how would that look? Oh, sorry. So how would that look? Basically, we sell the hype and we holding the hype anyway for a long time. But if the price stays below the $74.25, we anyway holding our hype. We don't lose any hype, but we're getting money for the selling the call options. But what happens if the price grows and the high price goes above our call options? Well, that's why it's called covered calls. We are always hedged with this strategy. So we can lose hype token, but we cannot lose US dollar. So let's say the price is at $78, then our hype token made a profit in this week, right? Because we're holding this hype token and they went from $67 to $78 and we made $10 profit. But of course, we have to pay out everything above $74. So this means we have to sell some hype token in order to cover the option buyer. But in total, we have more US dollar than before. And such strategies, if they're done carefully, helping a lot to improve our spot high position and make a constant return on them. And we think that we can make like a 4 or 5% on top of the hype trading with such kind of option strategies. And that's very nice because they also hedge our drawdowns of our future strategies, because with the futures we're buying volatility, with the options we're selling volatility, and together they're making even more flat equity curve. And also we're holding a lot of hype token, and we can basically get a good and stable interest rate with hype tokens. All right, and this is where we are now with Hyperocket. So I explained to you we have the futures algos. We tested 16,000 algos, and we're running like a 30 to 50 algos now live in our portfolio. And we're working on the option block in order to increase our portfolio to make like a more return. And all this is based on our research factory, which is constantly working and generating additional algos. So in a couple months from now, we may be at 26,000 algos. So yeah, I think we're very set for the future with that. And thank you very much for listening to my presentation.